Little intro music here. All right, guys. I'll say that again. Craig with Real Estate and Mortgage at RAM podcast on YouTube. Today I've got a real special guest, Matt Hoper, or excuse me, Matt Jackson. Messed up your name there. But my goal in any of this is always to educate, inspire, and take the mystery out of mortgage and real estate. I've worked with Matt a few times on a couple of deals where I think there's some magic, and I think there's a absolutely fantastic program that Matt Jackson at Attainable Housing Advocates, and I have such a hard time saying that, Attainable Housing Advocates actually sponsors and pushes through other, sources of funding for this. They're a group that has a very unique program for home buyers within the FHA solar and wind program within FHA. Matt, how are you doing?
Doing good, man. It's been probably close to a year that we've been working together now. Pretty
Yes.
exciting.
Yes, it took a minute to get kind of get things up and rolling a little bit. I mean, the program itself is very, very exciting. And obviously I sat through a bunch of calls and stuff with you and a bunch of other people on it. But you know, I actually took advantage of this program and actually have closed three of these transactions with you guys. And I got to say, each one was an incredible deal for some incredible people. One in Arizona and two in Utah, which, you'd think that would be just the opposite if it's a solar type of a program. Um, Let me just say this. FHA is a great program and it helps clients, helps buyers get into homes. Debt ratio wise, it's a little more lenient on some things. And through FHA's wind and solar program, there's always kind of been this program available for, I believe, the last 10 or 15 years, but just nobody has ever really used it. Nobody's really done anything with it. About a year ago, Matt and I actually met and actually through an acquaintance of mine, and then suddenly all of a sudden it was kind of a big deal. But Matt actually went through it, kind of explained the program, and actually put boots on the street to actually make this program work. So, Matt, tell us a little bit about Attainable Housing Advocates.
Yeah, so we are actually founded by two individuals that were in the mortgage space. They owned a mortgage company for 25 years. And so the mortgage background is there. And there was always a hole in the market for us looking at homeowners that typically get into the home and they're depleting most, if not all, of their savings to get into that home, right? And a good majority of these people have been living paycheck to paycheck for a long time, right?
Absolutely.
And
Absolutely.
that holds true more today than it did even 5 years ago, right? I mean, more people are living paycheck to paycheck. And so the real foundation of our program was
Housing
when
costs aren't going down.
they're not, they're going up and they're going to keep
No,
going up, right?
housing costs aren't going down. The cost to get into a house is not going down.
That's exactly right. So when our founder exited from his mortgage company, sold his mortgage company, he's like, you know what? There's a real need in the market for somebody to come in and help people get away from paycheck to paycheck living, but also in getting into their home, have some financial stimulus to do so, right? And so knowing all the policies and understanding FHA's SWT policy and understanding kind of the needs of people that do FHA loans or loans in general, he created this program with two main goals in mind, Craig. So the first goal of Attainable Housing Advocates is to make homeownership more attainable, right? We want
Right.
to help get people into homes. A
Which is, I
lot.
think, everybody's goal in the mortgage and real estate industry.
Exactly.
Help people get into houses. I love
Ex-
this.
exactly right. So that's everyone's goal. Now, across the industry, not everyone's goal is to help people also stay in the home, right?
No,
Most
no,
people's goals are, hey, let's get people into homes.
that's
But
true.
yeah, I mean, the like a lot of people, especially program wise, have not been in the sustainability side. So that's the second goal of ours is we want to make home sustainability. So a core principle of our
Attainable and sustainable.
exactly right. So get people into homes, have them succeed on their mortgages. Those are the two goals of the program.
That's awesome. That's awesome. Now, you actually administer this through a program called Hoper,
Exactly right. So
correct?
Hoper
What does that
itself,
mean?
yeah, Hoper is actually an acronym. It stands for home ownership, promotion, education, and research. So as you follow that acronym, really the process of the program is we are heavy in financial education for borrowers. So before closing, they do a pre-closing financial education course with us. It helps them to get out of renting, understand the importance of home ownership, get them excited for home ownership. And then it also helps them avoid the typical pitfalls that people fall into getting into a home, right? And it gets them excited about getting a loan, which working with someone like you, Craig, they come to you excited when they're pre-qualified for an FHA loan to utilize their knowledge to then get into the home. And then once they get into the home, we provide continued financial mentorship with them. And that comes along with a financial advisor.
Yeah, walk me through that. So I believe you reach out to them for an additional 2 years. Is that correct?
Yeah, for several years after getting into the home, we track the performance of their loan, right? There exists within the lending space what's called the mortgage default bell curve. And what it represents is it just shows in the first several years of the mortgage is when most people are going to default. And our main goal is to help people default less in those first several years, because once you get past year 4, year 5, your chances of defaulting go really, it flatlines, right?
It goes down tremendously.
It goes down tremendously. So our goal is to track how you perform. And so far, people in the last several years have been performing much better through our program using, our program with their FHA loan.
That's interesting because, us as lenders, there are certain things called an early payment default, after we've closed a loan. And a lot of times after we've closed a loan, sure, do we want to borrow, do we want to bother the client every month? Oh, hey, how you doing? Are you paying your payments or anything like that? And I'm not saying that's what Hoper does. But a lot of times we don't even know how the client is actually doing because we're probably not going to reach out for at least a year to get the seasoning on the loan before we even look at maybe a possible refinance, lowering some rates or something like that. So occasionally we will have a deal popped up that goes, doop, oh, your client just did an early payment default and is past due on their FHA mortgage. Can you help us call them? So I love the fact that you guys are actually following these guys and reaching out to them on a regular basis to actually make that happen.
Yeah. So part of that, and let me kind of get into the nuts and bolts of how we accomplish that there. Through our program, it's not just financial education, it's financial stimulus, right? So participating in our program, borrowers earn, or FHA borrowers can earn 3.5% up to $13,000. And they
say, hold on here. Whoa, hold on here. What you're telling me is if they take this program, which I believe is a 6-hour online class, you give them up to $13,000 or 3.5% based on the purchase price of their house.
That is correct. That is correct. And they get to use that toward closing. This is earned income, Craig. This is money that they earn. They don't have to pay it back. They don't have some second lien on their home. In a lot of cases, it's not raising their interest rate like a down payment assist program might, right? It depends on the lender, but yeah, it's incredible.
Well, so from the 3 deals that I've done, I can attest that the interest rate that I got for clients on this program was much better than a down payment assistance style program through some of the housing authorities. It was actually the interest rate might have been 1/8% higher than my standard FHA versus actually being 1/2 to 3/4% higher on some of these down payment assistance programs that are out there. That's one of the reasons why I think this is such an awesome idea and an awesome program. Now let's kind of get into that. Free money, everybody's hearing free money. That's great, but it's not necessarily designed just as a down payment assistance. It kind of sounds that way, but it's not. It is a financial stimulus for helping them with closing costs, possibly even paying off a debt or putting some money in the bank to insure against that default or possible, several months down the line, all of a sudden, hey, this mortgage payment I'm making on a monthly basis is a little bit difficult, but I have a little bit of financial resources set aside to be able to make sure that that's taken care of.
Yeah, no, you're spot on. So it was never designed to be a true down payment assist program, right? This program is a financial stimulus program. It's a research program, right? People are getting paid for participating in research. And the research we're conducting is we're trying to make it so that people are more sustainable in their home. We're wanting them to have success on their mortgages. And so if people come to the table with their own down payment, and they take this money and put it into savings like you talked about, Craig, it's a huge win for them. They have something to fall back on. Because most people, the number one indicator of someone defaulting on a mortgage is a lack of savings early on in the mortgage. So that's why we wanted to help people boost their savings. Now, there's another mechanism in there, and what we can talk about this, Craig. There's another mechanism in there to really help with savings, right? If savings is the number one indicator of someone having success on a mortgage, how can we help boost their savings aside from just them earning the income to get into the home? And that's really where the solar piece came in for us, Craig.
Interesting. Let's touch on the solar piece because this sounds great. Hey, there's $13,000 financial incentive, a stimulus, maybe help with some closing costs. Maybe I can combine it with maybe even a down payment assistance type of program to actually just be better overall. But it is an FHA solar program. Give us the nitty-gritty on that.
For sure. So our program, it's three pillars, right? We talked about the first two, which are the pre and post-closing financial mentorship pieces, right? It's really important to us to have the education in place. We also needed a mechanism, Craig, to help people boost savings early on the mortgage. Like I said, that is the number one indicator. And so years ago, you mentioned this, FHA created a policy called the SWT policy. And for a long time, this policy really didn't get utilized. And we found really FHA, when they created this program, I'm imagining what they're thinking. They're sitting there thinking, hey, solar's a really good technology. We think it should exist across the marketplace, right? But the way that it exists in the marketplace, you've seen it, Craig. The way that solar's been administered is it comes with inflated cost, right? Due to several people getting their hands in the pot. It's financed terribly. It's financed through typically a solar financer, and it comes with what's called a dealer fee, which is a big commission cut.
Right.
And then there's what's called a UCC filing. And what that means is you go try to sell your home with one of those financed solar pieces, and it's really difficult to sell your home.
Yeah, we've seen a lot of that.
It's difficult, right? And so FHA really saw this and said, hey, we want to make it so that people, as part of their FHA loan, can just wrap solar into their loan and make it so that it's part of the first mortgage. So it's a fully owned system at time of closing. That system is fully paid off, right? So there's no UCC filing.
Yeah.
Not a bunch of people getting their hands in the pot. So in most cases, you're getting a lower cost system than you would typically get from someone walking door to door, right? Knocking on your door.
Well, I can attest to that. Doing three of these, I know that you guys are working hard to, not only get the savings, the stimulus for the clients, but also being okay with getting them a system that serves their needs and, more importantly, saves them money on a monthly basis.
Yes. So this is where the solar piece came into play for us, Craig. The utility bill, the energy bill for a typical borrower or a homeowner, it's the third highest bill we have in America, right? It's usually our mortgage, sometimes like our car payments, number two, and then our electric bill is number three. Now, across the country, there has been a 15% increase on average, the last 5 years, a 15% increase on power payments across the country. That's crazy, right? If you have a $200 bill now and 5 years down the road, every year 15%, you're going to be several $100s higher on your electric bill, right? And so the goal of the solar is to help you save on your electric costs that are going to keep going up. Especially, Craig, we have AI around the corner. I mean, it's already here, and it uses much more electricity, a lot more strain on the grid, which means power costs continue to go up, right? And so the solar piece is designed to help you save on your electric bill, right? Your mortgage goes up slightly because you're going to add that to the mortgage, but your electric comes down. So typically your mortgage with solar is the same as or less than what your mortgage and electric would be. And over time, that electric keeps going up. You're saving more and more over time. Right. However, Craig, sorry, did you want to stop there? Or did you want me to?
I was just going to say that, yeah, I mean, in looking at the clients that I've actually dealt with, their savings that they were going to have on their electric bill versus, the cost of putting the panels, that's obviously important and necessary in this program. The cost of the panels, I mean, I'm just spitballing here, but I think a couple of them one was 197, one was 175, on their mortgage payment, so to speak. Because the magic of this program is I can actually finance those solar panels in the mortgage. Let's just call it this. Let's say it's a $400,000 purchase price on the home itself, but it costs $35,000 for the solar panels. I can actually go above the appraised value with these solar panels. So if the appraised value came in at $400,000, but I've got $35,000 in solar panels, that's $435,000. FHA allows me to go up to 120% of the actual appraised value for solar panels. Now, not a single client has actually gone that high. I've been about 105, 106, 104.7, never 120%. But they've also added those solar panels included into their mortgage, which if they sell their house, it's already included. Someone doesn't have to take over their loan at 18% someplace else to try to actually get the solar panels or anything like that. It just made sense. And it was all in a concise, nice way to do this with a low interest rate to boot through FHA. Sorry to cut you off, but I'm just, my wheels
No,
are spinning here,
right.
and absolutely, and the client that we closed down in Arizona, I think their electric bill is one of the biggest because, it's hot down there. And of course, down here in Utah, up here in Utah, sure, electric and gas during the winter is a little bit higher. But that electric bill, if you're, dropping that down, sure, your gas might go up, but I mean, maybe your electric bill here might be 10, $15. I think in Arizona it's a little bit better because I think they can get away with a lot more reduction in their outgo as far as electricity than they do here in Utah, maybe.
Yeah, yeah. So every market's a little bit different, but we see people even in, northern states. We have people in Minnesota, Wisconsin, all northern states that utilize this program. And financially, when you run the numbers, it makes a ton of sense. And especially so with the tax incentive that's associated with going solar. So
Right.
at the end of 2025, we're on the second to last day of 2025.
Yeah, I guess we got one day left, huh?
That's right. The solar tax credit that has existed for years is going to be going away at the end of the year.
Gotcha.
However, the big beautiful bill presents another opportunity with solar tax incentives. So through our program, they will get, and I'm not a CPA, so I
Right.
gotta put that out there quickly.
Throw
But
that caveat out there.
yes, we work with one of the biggest tax groups in the country, and they found a way through the big beautiful bill to have solar that's fully owned. That there's this tax incentive that comes from the big beautiful bill, right? And that allows a typical homeowner, let's ballpark it, it's typically between $5,000 to $10,000 that they get in tax incentives within a year of getting into the home. So let's say
Interesting.
that they get into the home early in 2026, they earned the $13,000 or the 3.5% to get into the home, right? If they put that into savings, they've got a lot to fall back on. If they use as their down payment, they have energy savings and they still have their financial education that we provided them. Now, they go to file for taxes in 2027, they have a financial benefit of typically around $5,000 to $10,000 that helps them once again early on in the mortgage to boost their savings and have something to
Right.
fall back on. So
Right.
really powerful, and that's really where the solar mechanism came into play for us is monthly savings alongside the tax incentive that happens on the back end.
That's very cool. Well, obviously, on this podcast, it's for real estate and mortgage, and we want to educate as many realtors as possible, as many
Yeah. So, Craig, let me just put a shameless plug. I work with a lot of loan officers. I mean, I work with over 1,000 loan officers and continually work with them day in and day out. Craig has been tremendous. I'm not saying that because I'm on your podcast, Craig. You are on top of the ball. Your clients have a really good understanding of what they're getting into, and the process is super smooth with you. So, really fantastic. And as a broker, you have the option to have all these wholesaler groups that you work with, right? And constantly, these wholesaler groups are adding new options with our program that just benefits the borrower even more. Shameless plug to you, Craig. I know I'm on your podcast, but even if I wasn't on your podcast, I'd say it. Yeah. You're exactly right. Yep. It needs to make sense for the borrower. We want them to have the energy savings. We want them to have the tax incentive, make everything really work out for the borrower. So that's an important factor for qualifying someone for our program, right? Now, you also mentioned this, someone that's already in the home, right? This program also works for refinances. So let's say that you use another program to get into the home, right? And you would like to have solar. Now, I told you I work from home. I've got my child coming in here thinking it looks awesome. Come on, say you want to say hi? Yeah, there you go. There's my guy. He's Brooklyn's corner. That's right. He's a little stud. He's a good one. So really cool. You get into the home and you want solar, you can refinance FHA and utilize our program. So you can earn the same amount, 3.5% on the appraised value of the home, up to $13,000. Now, when you refinance through this program, you can have that just go directly to your savings account, right? We want to help you boost your savings account so you can get the lower interest rate, you can get solar at the lower cost, and you own it outright. So really a huge win for refinancing as well. So same as before. It's 120%. There you go. I love it. It is 120% on the refinance as well. So that brings up a couple of points. Yeah. So it brings up a couple of points. You can have a purchase price at the FHA limit for the county. So let's say your county limit is 600,000. You can go up to 120% above that. So the purchase price remains the same, appraisal remains the same, and you can still do up to 120%. Now, on a $600,000 purchase price, we're never getting there on solar, right? But it's just important to note that you can go that high. Wow. Yeah, we've had people, so you probably have clients that have done this. They've used a DPA program, right, in the past, years ago, and they have a second lien on their home. They've used our program, right, to refinance their home, get to a standard FHA rate, take that extra money, pay off that second lien from the DPA program, and get down to the standard rate. We have people all the time too, because the money can be used to pay off debts. We have people that are looking to refinance, get to the lower interest rate, and they have six, seven, $8,000 of credit card debt, but it's at a really high interest, right? It's at like 20 something percent. And so they refinance, they use the money from the program to pay off debt, and it's a huge monthly win for any borrower in that scenario. Well, that's what makes you so good, Craig. You got your wheels always turning, right? You're always looking to do something. Yeah, so this program, everyone that does an FHA loan would benefit financially through this program, right? So if you were doing FHA, this program is for you. It doesn't matter if you need the money to do certain things like a down payment or paying off debt or lowering your interest rate. This program benefits you financially regardless of your position. I'll give you an example, Craig. I had a borrower, she's a financial advisor at Edward Jones, and she said, Matt, I don't need the money. I got plenty of money for down payment. I got plenty of money, but I looked at the numbers of this program and financially it makes a ton of sense. And since then, she's loved the program. She loved the financial education. She's like, the financial education is really good. I'm going to tell all of my clients that are looking to buy a home that they need to go through this program to do it. And so we're talking about someone who lives financial advising, right? And lives for making financial sense of things. And she said, this program is just incredible. To that point, we've added in the last couple of months, we pay for a financial advisor for all of the people that do the Hopper program. So whether or not they want to utilize this financial advisor is up to them, but they will give them advice on how to take that tax incentive they just received, invest it properly, help it build and grow wealth so that people can get out of the paycheck to paycheck living cycle that they're in, right? And so really the goal of our program, it is financial stimulus coupled with financial education with energy savings to help you long term to really be in a good position getting into a home. We have really good financial backing. So Hopper itself is self-funded. It's seed money, right? But we have significant amounts of money coming into the Hopper program to make sure that this can last for years on end. So we will be around for years to come. Yeah. Yeah. Yeah, exactly. Quite a while. Yeah. Yeah, and I always arm people. We have a new Hopper calculator, value calculator. I'll share it with you, Craig. Something that you can utilize with your clients. It'll go through and give them the year one benefit and the long term benefit of utilizing our program. And typically, the year one benefit is close to $20,000 to $25,000 in 1 year of getting into the home, and then long term, it gets into the six figures, right, of utilizing the program while coupling it with the financial education and investing that money somewhere that's good. So I'll share that calculator with you as well, and you can share it with those you want it. Yeah, mid 70s. Well, come down, Craig. Come down and let's go golfing. I'd love that. Thank you, Craig. Pleasure. Have a good one.